The first one's Equinox. So this is a billion-dollar market cap company headquartered in Toronto, based in Canada. Ross Beatty, who's kind of a mining legend, a billionaire built on mining stocks, is the chairman and owns 8% of it. So that's always a nice thing. And I think they have one of the best management teams in the business. And that's extremely important in this area because I should say gold mining is a difficult business. You're breaking rocks and Murphy's Law applies. And there are a lot of things that can go wrong. And sometimes they do. It's just a matter of how it works.
I mean, if we take a look at this company, it was trading at $8.90 back in April, and now we're trading somewhere around $3.50.
Right. So to me, it's an incredible bargain at these levels. And this is a reflection of the macro that we were speaking about earlier, right? I mean, everyone thinks that the Fed will be successful in containing inflation, and therefore you won't need gold stocks. I personally think everyone's incorrect in that assumption, but obviously that's why they're markets. So these guys are based in Canada, and they have 7 producing mines, and they're in safe jurisdictions, and that's important too. I mean, when you're picking gold mining stocks, there's some companies that operate in countries that are not friendly to gold mining or that can seize mines or tax mines, and so I think Ross has been rather smart here. His portfolio of companies is in the United States, Canada, Mexico, and Brazil. So in my opinion, those are all safe countries, even though South America is a place where, well, there are others, but South America is one of the places where there's some countries that are uninvestable, in my opinion. And so he's got 7 operating mines, and then he's got 4 growth projects and expansion in those existing mines. And I think the most interesting thing here to me is, to me, the lowest risk category of investing in gold stocks, and they're really 3 buckets, right? They're the producers, they're the developers, and the drill stories. The producers are the safest because they have positive cash flow. When you have positive cash flow, you can't go bankrupt, right? The development and the drill stories, they all need to absorb cash to hopefully produce gold. And so this is a producer. In this year, they should have $250 million of EBITDA with a market cap of $1 billion. That's 4x EBITDA. That's not bad, right? Compare that to Apple or some of the others out there. But more importantly, and as I was saying, I think the lowest risk category are producers that are growing, because you could buy Barrick or you could buy Newmont. The problem they have is that they have 5 million ounces a year of production. And remember, a gold mine is a wasting asset. You're pulling gold out of the ground. Once you've done it, it's not there anymore. You got to find more gold. So it's like being an oil company. You're always looking for new resources, so you're always exploring. And in my view, when you're smaller, it's easier to replace what you mine, because if you're Barrick or Newmont, it's hard to find 5 million ounces of gold a year. I mean, they're barely managing to do it in some years. They're not in others. In this particular case, Equinox has been able to grow their resources very nicely. They currently have all category resources of 30 million ounces of gold. That's pretty interesting, because if you take the market cap, divide by 30 million, that means you're paying $33 for every ounce of gold in the ground. Now, if they were above ground, they would be worth $1,700. Obviously, the difference is you've got to spend money to mine them. And so, the thing I think that they've done a nice job with here is they've got a nice basket of assets, and they've got a nice growth pattern. This year, they'll mine 580,000 ounces of gold. And next year, a few years out, I think they're going to get to close to 1 million ounces of gold. So that's 40% growth in the underlying gold that they're mining, and that's unusual in this industry. So this will, projected Bloomberg consensus projected EBITDA in 2024 is $500 million. So that would imply that they're selling at 2x 2-year out EBITDA, which is pretty cheap. So it's a good situation, and typically the way you value a gold company, or one of the ways you value a gold company, is you put a price on each ounce that they're mining. So gold companies tend to be worth between $4,000 and $6,000 per ounce of gold that they mine. And if you applied that, I forgot to do it before the interview, but if you apply that to the 580, even if you apply the low end of the range, $584,000 an ounce, that would be $2.3 billion. So that's a double right there at the low end of the range. And then, I think the number of ounces they mine are going to grow. So I think it's got a lot of potential as it re-rates higher. And, I like the management team a lot, and I like their odds of doing it. There's some reasons why it trades cheap. One of them is they've got a development project called Castle Mountain. And people are worried about cost overruns there. I'm not. again, because of the way they've done the project and the way the management, the skill of the management. But that probably is part of the discount in the stock right now. But I view it as an opportunity.
And I'm curious, I think you've made the why now very, very apparent, though I should note, I was reading a note earlier that put lower support at about 325.
Right.
But when you look at your time horizon here, that's one of the most important questions that Rao
It
always
really,
talks
it,
about.
it
And
really is, and that's a great question, Samuel, and that's important with these stocks, right? I mean, look, I thought it was cheap 3 months ago, got cheaper, right? And you could buy it here, and it could get cheaper still. So I think you got to keep that in mind. And one of the things I advise when people are entering this area is to dollar cost average, and going into them, because we don't know when this will turn. I mean, I think the next run up is somewhat dependent upon gold believing that the Fed is going to ultimately have to accommodate the world by not being as monetarily tight as they currently are. And I think that's an almost certain event if one looks at the math very carefully and the federal deficits that we're running and the cost of servicing those deficits. So that, in my view, will create a higher gold price. Gold will go through 2000 and all these stocks are going to go bananas. But I can't tell you if that happens tomorrow, or if that happens in 3 months, or if that happens 6 months, or maybe as long as a year. I kind of doubt it'll be as long as a year, but it could be. And so I think it's important, if you buy something like this, to have patience to let this thing play out over a couple of years. I'm pretty confident that, I mean, unless the Fed is successful at what they're trying to do, and I suppose it's possible, I'm pretty confident that 2 or 3 years out from now, this is a much higher price on the stock.
Larry, I want to ask you, what is the thing that's most likely to upend your view on this idea?
The fundamental view on this particular company, boy, not much. I mean, I like the company's a damn good company. I mean, I suppose if Canada or Brazil or Mexico decided they wanted to seize the gold mines, that would be a real problem, right? And that's always a risk. I mean, these things are, they're literally pulling money out of the ground, and governments are always very hungry for tax revenue, et cetera. And corrupt governments have seized gold mines in the past. We can all debate how corrupt these three governments are. That's a different question. But I think that's really the biggest risk, is the governmental risk. I mean, the nice thing, when you've got 7 mines operating, you've got diversity, and that's partly why you want to, in general, newbie investors in the gold space want to tend to stick to bigger companies, because the fact that they have a lot of properties reduces the risk of one property going bad. Remember, I spoke earlier of Murphy's Law. I mean, things happen in mining. Mines flood, the grade taps out. There are all kinds of, you have cost overruns, et cetera. The mining business is not a simple business. It's a difficult business.
And I'm just curious about Brazil. I mean, you talked about their exposure, U.S., Canada,
Yeah.
Mexico. We'll talk about Mexico a little later on, but with Equinox having the exposure that they have in Brazil, and I think of the fairly wild political leaps from the last president to the current one in the lurch to the right. I'm surprised that you say that Brazil is such a sturdy choice here. But in terms of mining, I mean, this is the field that you know.
Yeah, well, you're right. I mean, Brazil. I mean, it's not perfect, and neither is Mexico, by the way, and for that matter, neither is Canada. But it's my belief the mining business in Brazil, pays a lot of taxes and pays a lot of royalties, and we haven't seen anything in Brazil that would imply that you're not seeing the kind of problems in Brazil that you're seeing in Peru or Chile or Ecuador. In general, they're taking a live and let live approach. And recall that the thing that's a counterbalance to the governments getting aggressive on these companies is that these companies pay governments a lot of money, and the governments do not know how to mine these deposits. I mean, Venezuela seized all their mines thinking they were going to get rich, a bunch of years ago, and it didn't work because they didn't know what to do with them. So, it's not risk free, obviously. But I think Brazil. The other thing to keep in mind with some of these South American countries is, politically, like in many places, they talk tough about a lot of things, but at the end of the day, they know there's money coming out of these mines that they need, and so the rhetoric is designed to win votes, but behind the scenes, the activity is not that threatening.
Okay, so I want to shift gears now to your second idea. This is Osisko Mining, another Canadian company. You'll see that theme here. This is a development story. And you say this is a company that's run by what you call Canadian mining royalty, and there's a big focus in Quebec right now. So tell us about Osisko.
Yeah, Cisco's really, it's probably one of the best deposits in the world. And that's, what really counts in mining is the deposit, the size of the deposit, and the grade of the deposit. And grade is the measure of number of grams in a ton of ore that you mine. And there are mines that operate at a grade of zero point 0.4 grams per ton, and 15 or 20 grams per ton is kind of lights out, and very rare. This company has an enormous deposit. They have 8 million ounces of gold, and their grade is 11.4 grams per ton. That makes it one of the 5 or 6 best mines in the world once it starts operating. It's not operating yet. It's run by what I consider to be probably the best mining CEO I've ever met, a guy named John Brzezinski, who helped discover and daylight and produce the largest mine in Canada, which is the Canadian, one of the two largest mines. It might detour maybe slightly bigger, the Canadian Malartic mine. And so, the guy really knows what he's doing, and they've really drilled out a beautiful deposit, and the economics on it are quite compelling. They are not producing yet, which represents a risk, and yet the economics are so strong, and they have so much cash on the balance sheet and no debt, that I have very little doubt that they will be able to easily finance the ramp up to production. And I just met with John at Beaver Creek, the gold mining show, and he told me he's highly confident that they're going to have first pour in the first quarter of 2025. So that would imply we've got 2 years where they are not producing gold yet, but at that point in time, they would produce 300,000 ounces of gold, which, if we apply, the metrics we were talking about earlier, and the gold price stays in this area, goes slightly higher, it makes this company worth about $4 billion. And right now, the market cap is $650 million US.
If we pull back and look at this company, it's come off highs of about $5 Canadian dollars, of course.
Yeah.
OSK is the ticker. We're looking at 277 now. So if it were to go lower, would you view that as an opportunity?
I view it as a buying opportunity. I doubt that it will go lower, but it could. It's pretty well understood. And, it's cheap at this price, only if you really understand what the asset is. And it's hard because you can't multiply by cash flow here. But, I guess you have to understand geology and just how rare large deposits of this quality are. And he told me when I was there, they've done one of the things you do in mining is you do reconciliation studies where you say, okay, we've drilled out this area and we think it's got, a grade of 8%, 8 grams per ton. And then you go down, and by the way, he's got an underground decline of 12 kilometers already. They're already basically setting the mine up. I mean, he's building it. And he did 2 of these studies where they had the block model that showed a certain grade of ore underground. And they pulled them out in the reconciliation. I think one they exceeded by like 30%, the other exceeded by like 70%. So, I mean, which implies that they've been conservative in the numbers that they've estimated. And that's why I think he's one of the best CEOs out there. The good CEOs in this industry, they underpromise and they overdeliver. And then what that leads to is the stock doing extremely well because people know that they can kind of trust the guidance coming out of the company. Some companies, even pretty good companies, occasionally will overpromise and underdeliver, and then the stock really gets in a hole and it's hard for it to get out of there. And so the thing that, I think I said it to you in the pre-show. I mean, if I had to pick one stock that I was going to give my mom and my kids, and, I was going to quit investing and say, wake up in 10 years, you'll be good, you'll feel good about it. This is it. I mean, there just aren't any deposits that look like this. This company is going to be worth billions and billions of dollars, in my opinion.
And you just mentioned 10 years. When we talk about time horizon with the first company with Equinox, you talked about 2, maybe 3-year time horizon. That's a producer story. But here, this is a development story. So would the time horizon be longer then?
It is a bit longer with the development stories because you got to daylight them. And the producer stories, they have to keep producing what they're producing year after year. And this will become a producer. But I guess the point, the first one had a bunch of mines, none of which looks like this mine. I mean, this is really, I mean, this when it's all said and done, if we have a bull market in mining stocks, I mean, this could be Microsoft, right? I mean, this is, to my way of seeing, it's just a really, really high quality deposit. there aren't many of those in the world. I mean, there are probably five that look this good, and that's why I like it so much.
And what's most likely to make you wrong in this scenario? I mean, I don't think it could be a
Yeah, well,
politics situation in
yeah,
Canada.
yeah, the geology, there's not much doubt about that. Most smart geos totally agree with my view on that. I mean, I think there is a risk, although I think John has been quite conservative, and I think they've been careful in budgeting in terms of what it's going to take to build the mine. There have been several cases recently of big capex blowouts, which is to say people trying to build mines and they discovered it cost them much more. I mean, in an inflationary environment, diesel's up, explosives are up, steel's up, etc. And you've had a couple of famous companies that I Am Gold and Argonaut, both of which I own, blow up because the capex really blew out. And I think there's a chance the capex will go higher here. It's capex is in the $500-600 million range, recently estimated. So I think he's got the right numbers in there. But let's say it's 700 or 800. I mean, in the context of a mine that will be worth 3, 4, 5, $6 billion, if it costs 700 to build it instead of 500 to build it, it's not going to be the end of the world. It's obviously not a good development, but
And Larry, in this environment with inflation really affecting those capex capital expenditures, how often do you want to see updates from companies more than just their quarterly reports?
oh, absolutely. And all these companies are very good about it. And some of them will even, yes, on a regular basis, monthly, quarterly, and they do. I mean, they do. The good ones do. And that, again, that's how, it's very important. If people are looking at this area, it's very important to be a stock picker and to try to stick to the very best names. I mean, the industry indexes will do fine in the context of a rising gold price. But within that, there are names, and that's why having professionals who are familiar with the area help you in this area is worthwhile. There are names within the group that are just significantly better than others. And I think this is, as you said, you asked for my 3 top picks, and this is one of my 3 top picks.
What can I say about Mr. Lepard's interview here? If you ever wanted to invest into gold mining stocks, now could be the best time to do so because inflation seems to have peaked and most likely will come substantially down over the next 1 to 2 years, in my opinion. And if this happens, the cost of mining will decrease, and this is very, very profitable for these mining stocks, especially if the gold price stays at these levels or even increases further. And this might happen because the overall macro environment isn't stable and people are fearing recession and the overall geopolitical circumstances. So it might be the best environment for gold mining stocks. This is the only thing that I could add to Mr. Larence Lepard's interview. One more thing I want to add is that the political risks for these mining companies are substantial. Because if you fast forward 1 to 3 years into the future, we might see a substantial recession. And at that time, the governments around the world, they are probably desperate for cash, and they might come after these mining companies either through taxation or nationalization. That's the great risk in investing into these mining stocks. But what I would do is just invest a small portion into these companies because if it doesn't happen, and Lawrence said that the risk might be lower than most people think, these mining stocks might offer great returns into the next 1 to 5 years, in my opinion. Thanks for watching and see you in the next one. Bye, guys.